Last but not least, we've got Regis Resources here. Jim Bayer is the Managing Director and CEO. Jim's been MD and CEO of Regis since October 2018 and is a mining engineer with a broad range of strategic and operating and startup experience encompassing more than 30 years across a number of commodities including gold, copper, uranium, lead, zinc and iron ore. Prior to joining Regis, Jim was the CEO of ASX-listed West Australian-based iron ore producer and explorer Mount Gibson Iron. Jim holds a Bachelor of Engineering and a Master of Geoscience and is the President of the Association of Mining and Exploration Companies, otherwise known as AMEC Executive Council. Please join me in welcoming Jim to the stage.
Thanks, Jeremy, and first of all, congratulations on being the backstop to 2 hours of solid presentations. I think that's the longest session that I've seen for quite some time. Look, thanks everybody for joining us at this last session. There's always a warning that exhibits getting between the last session and the wheelbarrow with the beers in it, but I'll do my best to make it informative and brief and to the point. First of all, of course, draw your attention to the cautionary statement, which is the antithesis of to the point and brief. We also have an exploration target that I'll be talking through, which we issued a month or so ago. Look, Regis, and where are we and what do we do? I want to spend a little bit of time just talking through what our growth plans are and how they're travelling and where we see the company going, not just in the next 6 or 12 months, but also well beyond that. But first of all, I've got to cover off on who we are, what our assets are. So we have 2 production points within Western Australia. The first is the long-running asset at Duketon, which is actually made up of 3 mills. It's on Matnjarra country, and we're very pleased with the relationships that we have with the traditional owners there. And Duketon produces this year, our guidance is between 280 and 305,000 ounces of gold. The second major asset that we run, or we don't run, sorry, but we have a 30% share in, Anglo Gold run it. You heard earlier today from Terry on Tropicana, is the Tropicana gold mine, a combination of open cut and underground. It's on Wongatha Spinifex country, and Tropicana, from our perspective, with our 30%, our guidance on that is 135 to 150,000 ounces. So you can see we're in this 415 to 455,000 ounce guidance range. And in the future, sitting over in Wiradjuri country, over in New South Wales, we have the McPhillamys project, which is probably about 15-20 kilometres away from the massive Cadia complex. And McPhillamys, when it's in production, we're anticipating will be 165 to over 200,000 ounces per annum. Depending on which year it is, the grade actually improves with depth, so it's a real good asset. We have 7 million ounces of resources, and we have just under 4 million ounces of reserves. So what's the investment highlights, and what is it that we want to point out that is the difference that sits within Regis? The first is clearly we have a high quality portfolio. We have the ability to target, and we are targeting 500,000 ounces per annum, and I'll talk a little bit about that later as to how we see that coming together. As you saw before, we're 100% Australian assets in a country that has got very manageable and understood risks. We have 8 years of reserves on average. 2 of our assets have got 10 plus years of life, and we're the 4th largest Australian gold producer. We have a strong financial platform. Our operating cash flows from our business are very solid and very strong. We have a net debt position of 57 million. We had 243 million in cash and bullion at the end of the last quarter, and 300 in debt. And we will be currently, and I'll again talk about this a little bit more, but by the end of this financial year, approximately 10 months, 2 weeks and 3 days, we will be hedge free, and the implications on that are really quite significant for us as a cash-generating business. And finally, on the organic, we have a growth front, which is significant in that all of it being in the organic or internal opportunities with McPhillamys. Our Tropicana Underground are only really just getting started as we see it. The Duketon Undergrounds are starting to hit their mark as well. And we also have a very dominant position across both the Duketon and the Tropicana gold belts. So how do we go about doing our business is a key element to the way that we look at it. There's no point making gold if it comes at the expense of flesh and blood and long-running legacies that are not appreciated or are bad for us. A bad reputation is no good for anybody. It's not good for us as a company. It's not good for us as an industry. Unfortunately, the small elements in the industry really do tar us, but we are very proud of the performance that we've been able to carry out. Very solid safety, where we sit 70% below the industry, the WA state for lost time injury frequency rate. We're a few percent above, if you measure diversity by male and female. We're 21% females in our business, which is sitting above industry average, which is around about 19%. We've stepped up our land rehabilitation. Very important part here. We do it as part of our integrated business. It's twofold. It's limiting the liability. It's also doing it when it's the cheapest to do it, when it's part of your ongoing business. And it's also just makes sense to do it as you go. And finally, the last element, which is a project we've been particularly happy with in its progress, has been on carbon reduction, particularly in light of the safeguard mechanism requirements that are at us now, is the solar farm, which we're just in the process of commissioning. 9 megawatt solar farm, which has a material impact on our carbon emissions, but also a significant impact on the reduction of our fuel use. So looking at what we've been doing for the last couple of years and what the near-term phase of our business looks like. So for the last couple of years at least, we've been in what we've been really describing as an investment phase. There's two things that have been going on. We've spent over $350 million, or approximately $350 million, capitalising on two key areas at Havana. At Tropicana, the Havana open pit has been in a major cutback stripping phase, and will continue to be so for another year or so, and then it'll ramp down. We've also been in a significant phase of investment at Duketon, particularly as we've been working on Garden Well Underground and also some of the other satellite pits that we're now bringing into production, including Ben Hur. But where are we? And over that time, you'll see that our cash balance has dipped and moved around a bit, but has really, over the last 2 years now, has remained pretty steady. And sitting over the top of that has been a hedge book that we've been working our way through steadily to the tune of about 100,000 ounces a year. Now, we've been selling into that hedge book at $1,571 Aussie an ounce, so it's been quite painful for us to watch that go out. But the beauty is, this year, or in the June quarter, we've completed commercial production of the start-up at Garden Well Underground, and we've also completed commercial start-up of the Havana open pit. So we're seeing the two big investment areas starting to come in and deliver into our production phase. Looking at the next 12 months, we see that we'll be at Tropicana. The cutback will start to, in about 12 or 18 months' time, the cutback, we will have broken its back, and we will see the total material movement start to drop off. So while Tropicana at the moment, its total cash invested, or its total cash costs there are remaining pretty steady, the production is lifting a little bit with the improved grade that comes from the Havana open pit. And we will also see in about 12 months or so that the costs will start to drop off. As I said, we've broken the back of the open pit cutback. The production levels still remain up, and our cash costs start to drop off. That moves into a real cash harvest phase. The other material impact that we'll see on our business is that we are selling this year the final 120,000. We kicked off, we had over 400,000 ounces on this hedge book. We're now on the run to the end with 120,000 ounces, and they will be gone by the end of June at the latest. Now, what does that mean? That means that at that point in time, we will get the equivalent of an extra, at today's prices, an extra at least $150 to $160 million pre-tax in our cash flow. Now that is the equivalent of a new mine startup, but it doesn't have the risks that are involved with it. There's no commissioning, there's nothing else, we will just run and continue to run the way that we have done, and what we will see is a material impact on our cash flows at that point in time. So that happens over the next 12 months. Looking a little bit further out, what happens to our business? Well, we see that we've got a pathway to get to 500,000 ounces per annum in FY27. And how do we get there? Well, our two key production assets gets a partner and a third, and we get Duketon. We see Duketon operating in this 200 to 250,000 ounce range, and that's on the basis that we don't find any additional open cut material, and it just runs on some satellites that we've got and the undergrounds that we've been bringing into play. We see Tropicana continuing to produce at our share of it, 135 to 150,000 ounces a year. And then McPhillamys, on the basis that we get to a point of FID in the middle of next year, which is what we're targeting, 2 years construction, FY27 can be its first full year of, potentially of its first full year of production. You add those numbers up, you can see there's a clear pathway to get to 500,000 ounces. And the next key question is, how do we maintain it? It's easy to get to a point. How do you maintain it? Well, at Duketon, we see this on-rolling ability, this on-rolling story of our undergrounds, both Rosemont, Gardenwell South. I'll show you in a minute Gardenwell Main, which is a new potential area, and we see this great real potential for us to continue to follow what is a traditional pathway in Western Australia of open pits going underground, the underground's having 2 years of reserves, and 10 years later they still have 2 years of reserves. And we're seeing that unfold at Duketon. At Tropicana, we see that will continue to roll on towards the end of the decade. There's plenty of potential to find and add new reserves in the open pit, but the underground will continue on certainly well beyond the end of this decade. And as I said, McPhillamys will only have just been getting started, so there's plenty of time. So just to show you a little bit about how things have changed for us just in the last couple of years and why we're seeing this building in this confidence of what the undergrounds look like at Duketon. This is a slide from a couple of years ago, and it shows you what we were thinking at Gardenwell in the underground. So you can see the open pit, which is still in production, certainly in the northern end. Down the left-hand side, with the laser, if you can see it on the screen. I don't think you can, but over there you can see we had just recently approved the new underground Gardenwell, and we had a target area sitting underneath the deeper section of the Gardenwell pit. Now that was a couple of years ago, and what does it look like now? Well, it's busy, and it's very busy for a reason, because we've been doing a huge amount of work. That project, underground mine, is now a production area. It is operating and it is delivering ounces to the mill and has been for several months. We've moved our thinking in the area underneath Gardenwell Main, and we are much more confident that there's actually a new potential production zone there, and we're accessing it through this exploration decline that we've been talking about since nearly this time last year. So we're producing from the southern end. We're targeting this new production zone underneath Gardenwell Main with this exploration drive, and while we've been mining across it or driving down to the central underneath the main zone there, we've been drilling as we go, and we're already starting to see some very good intersections, and my best recommendation would be to pop by the booth and have a look at these intercepts if you really want to pay close attention to them. But what we are seeing is a clear extension to the north of the area to the south. So as we've been putting this decline in, drilling the area from both the surface and now the underground, we are building in confidence that we don't just have a new production zone in Gardenwell South, we have a new potential zone that's really pulling together underneath Main, and you can see that whole area in between the south and the main area is actually starting to fill out with some pretty impressive intercepts. We're very excited about the fact that of this whole area, and in fact the resource ranging work that we did has set a potential initial exploration target for the area that's just shown here for between 0.8 and 1.3 million ounces. And that's just in the area. This all continues down plunge and continues well beyond where our drill hole, where we're showing on this screen. So that's what's an example of what's been happening at Garden Well. What's been happening at Tropicana is a very similar story. You can see when we first bought this back in 21, underground production was only coming from Boston Shaker. Tropicana was just underground, was just being developed, and that was about it, and we were getting production from the Boston Shaker pit. The bigger Havana open pit is now in production. Boston Shaker just continues to roll, and in fact every year now since we've bought it, we've replaced depletion. In fact, we added a little bit last year. Tropicana has opened up into a new production zone. These, both Boston Shaker and Tropicana, are both open at depth. You can see the holes there. They're a couple of 100 metres well below any resource quality mineralisation. We get the same intercepts, 22 metres at 4 grams a tonne, well down plunge of the existing resources and mineralisation that's modelled. These are impressive ore bodies, and we've got a new potential production zone sitting underneath the Havana open pit, which is being worked on at the moment in a PFS. And then there's a bit of a twinkle in the eye sitting out overneath Havana South. There is great potential here. We're only just starting to see it open up from an underground perspective. So the other piece of our growth is McPhillamys. It's long life, 2 million ounces of reserves sitting over in New South Wales. Very pleasingly, we got IPC approval. We got that back in March, something that we had been driving towards for a number of years. It's a big step for us. It is now working its way through the other minor approvals in the state. We're sitting with a Section 10 application at the federal level that we're waiting for a closeout on that, and we're very confident that that will be favourable for us, particularly given the support of some of the local traditional owner groups there. We see ourselves on this timing pushing the project to an FID in the middle of next year, and as I said before, 2 years construction. Now the exciting part here is not just the deposit, but the fact it's open at depth. The drilling only stopped because we started only looking at the open pit. We do have a program of exploration this year to drill further down plunge. So we see this whole area, which in the whole Lachlan Fold Belt, delivering 150 million ounces over the years, we see great potential to continue that on the ground, specifically at McPhillamys, but also sitting across the road, we have Kings Plains, and we also have 30 kilometres away Discovery Ridge. We're just getting started in this area. It's got huge potential. Now, I won't spend too much time on the regional geology. We are very excited about this. We control about 90% of the ground. We're keen to, at Duketon, we think there's great potential there, and to continue the tradition of $50 reserves and $20 resources. There's so much, a lot going on there, and call by the booth and we'll give you some more information. Similarly at Tropicana, another brand new greenstone belt discovered with Tropicana. It's just being opened up. We have some very exciting potential projects there as well, not the least of which is Angel Eyes. We think that both at Duketon and at Tropicana there's enormous potential for additional deposits to be found, and we have the time to do that. So in closing, the investment case for Regis Resources. We have a strong financial platform. Our existing operations have a very robust operating cash flow position. We have a long reserve life with additional growth profiles. We're exclusively in Tier 1 locations. We've got a progressive and measured approach to ESG, and we have a dominant position on our prospective gold belts. And the one that I skipped over, which I think is the key one to keep in mind, if you look at our business and you spend some time understanding our business, you will see that the hedge book, when we work through that by the end of June this financial year at the latest, unless we consider something before that, that hedge book will be gone. And overnight, there will be an additional $150, $165 million of cash flow per annum in our business. That's over $12 million a month that will be added to our cash flow on the basis of current gold price. So if you just look at the fundamentals, we have a solid production outlook, we have a great cash flow position that's starting to open up and being understood, and we've got a whole lot of exciting opportunities sitting in front of the business beyond just the existing reserves. Thank you.
Thanks very much, Tim.